It's been a while since I've posted a video. This mortgage market has been absolutely insane. But let's take some time to answer a question that most people that are getting a mortgage right now are asking themselves. Should I go fixed or should I go variable? Now, in this video, we are going to answer that question, but I also want to be clear that that question is probably less important than some of the other questions that you should be asking yourself, and we'll answer some of those in this video as well. Now, for those of you that have been following my channel since I started it a year and a half ago, you'll know that I've already made a few videos regarding fixed versus variable mortgages. And you'll also know that if you've been looking at those videos, that for the time that they came out, that advice was spot on.
Impressive. Your parents must be very proud.
Last year was the first time in Canadian history that more Canadians chose to go the variable rate option compared to the fixed rate option. And this is somewhat baffling to me, because it's also one of the only times in all of Canadian history where it was obvious you should be locking in a rate. It's the reason why 98% of my clients ended up locking in rates that were at or below 2%. Meanwhile, most of the country was going for the variable rate option. So why did a majority of Canadians not lock in their rate? Well, we'll cover one of the reasons why it was so obvious to me that we should lock in the rate, how so many people got it wrong, and why that's relevant to today's choice, at least in part. And if you're watching this and you're saying, yeah, but Conrad, hindsight is 2020, know that most of these videos I created were before the rate hikes were even happening. I was telling people to lock in their rates even when the Bank of Canada was saying that they weren't going to raise rates until sometime in 2023, maybe even 2024. I'll put the link to those videos in the description below.
Are you still skeptical, Mr. Conrad? Watch this.
Now, in the past few months, you've undoubtedly seen a lot of news articles that read that this is the fastest we've seen rate hikes since the 1990s and so on, as if in some way the 1990s, 1980s, or some other point in time can give us insight as to what to expect this time around. And while that's partly true, there are literally more factors than ever before affecting the market. So interest rates could continue to go up, or they could stay flat or even come down, depending on how those factors play out. Earlier this year, I was predicting that the Bank of Canada rates were going to rise to 1.75% by the end of 2022. Well, we've already blown past that. Rates are rising faster than even I anticipated. But here's why that doesn't matter, or at least it shouldn't matter. Predictions are just for fun right now.
Now, here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market.
Markets are all over the place right now. They're caught in this tug of war as to which problem is going to be the largest, the inflation or the recession. And since none of us have a crystal ball, only a fool can claim that they're 100% certain in this environment. Here's what you can do though. We can make predictions about which way the rates will go. But what's more important than that is to make sure that our financing strategy doesn't require us to predict the future in order to be successful. Because any financing strategy that requires you to predict the future in order to be successful sucks. And that right there is the single biggest key as to why people should have locked in their rates last year. Let me explain. When it comes to mortgage financing in this environment, you have to stop thinking about fixed versus variable as one is right and the other is wrong. Last year, for instance, it was a no-brainer for most people to lock in their mortgage rates, and yet it still made sense for some people in some situations to get a variable rate mortgage. So fixed and variable isn't inherently right and wrong. It's more so your economic situation in the economic environment that you're in the moment that you get your mortgage, that more so determines that. There is no one size fits all. I want you to imagine for a second a line. On the far right side of this line is fixed rate mortgages. This is the epitome of stability. Your interest rate is stable, your payments are stable, but of course, the stability comes with a premium. And that premium is reflected in the rate that you get, because you almost always get a higher starting rate than if you'd choose variable. On the far left side of the graph, though, is the antithesis of this, the adjustable rate mortgage, also known as an ARM. And for many people, this is what most imagine variable rate mortgages to be. Your interest rate changes with the bank's prime rate, and your mortgage payment changes as your rate changes as well. You sacrifice stability in order to pursue potentially higher savings by getting a lower rate. Thinking of fixed versus variable rate mortgages as this trade-off between possible savings and stability is incredibly important in an unstable market. And I think if most Canadians had stuck to this rudimentary thought process through 2020 and 2021, most wouldn't have chosen a variable rate mortgage and missed out on the single largest opportunity to lock in historically low interest rates. Because if you truly see this whole fixed versus variable debate through that lens, then you ask yourself the next logical question. What is the premium that I'm going to pay for stability. Right now, you're talking about a difference of about 1 to 1.5%. That's a pretty substantial premium for stability. Last year, though, there were points where fixed rates were less than 1/4% more than variable rates. This means that the premium for stability was super small. A 10 to 25 basis point premium for stability? That's basically nothing. But okay, that's in the past. What should we be doing now if we're getting a mortgage in today's market? Well, what if there was a way to get some stability and only pay some of a premium? A static variable is a type of variable where your rate changes as your bank's prime rate changes. However, what does not change is your payment. That stays static and remains the same. Instead, the thing that changes is how much of your payment goes towards principal, actually paying off the loan, and interest. As rates go up, a larger portion of your payment goes towards interest, and conversely, if rates go down, a larger portion of your payment goes towards paying off that mortgage faster. And this, I think, ends up being a great recommendation for this point in time. And here's why. If you're a fan of my channel, you already know that one of my favorite questions to ask is, what if I'm wrong? Because it's great and all to have a plan in place for if you can predict the future, but what's the consequences if you're wrong? Last year, like we talked about, the premium to get a fixed rate mortgage over an adjustable rate mortgage was relatively low. And so if rates did skyrocket like we were predicting, well, you were laughing. But even if rates didn't climb and they stayed relatively flat for years to come, like the Bank of Canada and many economists were predicting, your downside was that you would pay $5 to $13 more per month for every $100,000 that you owed. That's it. Basically, either way, you were a winner. Now that the premium for a fixed rate mortgage is a lot higher though, and we've already seen a substantial amount of rate hikes, the math is a little bit different, but the questions are still the same. What if I'm wrong? With a static variable, let's say rates continue to rise. Until rates rise so much that the interest portion of your payment isn't being covered by your payment is going to remain the same. In that way, you don't have to worry so much about ballooning interest rates because your payment stays the same, unlike an adjustable rate mortgage. That way you can focus on the rising prices of things like gas and groceries. You've got the stability to weather the storm. Conversely, what if recessionary pressures continue to grow? And they likely will continue to grow. There's a chance that rates could drop. If you're in a static variable, not only do you have the benefit of your mortgage payments remaining fixed and stable, but if rates do eventually drop, you'll just end up paying your mortgage off faster. Now, with all that being said, a reminder that there is no one size fits all.